Do you feel like you're getting violated every time you get gas for your car these days? It's not just energy prices. Virtually everything around you feels like it's getting out of reach. And unfortunately, your salary probably isn't keeping up with inflation. The latest inflation number in the US sits at a whopping 9.1%. What is going on?
No, God!
So what does all this mean for you and your portfolio? Well, in today's video, I'm going to try to unpack all of this for you. After which, of course, you've gone and inflated that like button by giving it a gentle tap and subscribing if you haven't already. What's up, guys? Welcome to another episode on the Crypto Rabbit Hole, where if you keep falling, you'll keep compounding. I'm your host, CH. Now, you might be wondering why everything is getting so expensive and yet you're feeling poorer. Now, I'm no economist, but today I'm going to try to uncover all the macro factors currently at play. So the latest figure for CPI inflation sits at 9.1%, the highest in over 30 years. High inflation is horrible because your purchasing power will decrease, meaning of course you can buy less things. All fiat currencies have a history of devaluation and many have collapsed. So if you had $100,000 last year, that means you can only buy $91,000 worth of goods and services this year. Now imagine if this happened every single year.
Oh my God!
Oh wait, there's no need to imagine it because it does happen every year, just normally at a lower rate. The government targets a 2% annual inflation rate as the norm. Inflation usually comes in three forms. First, you have the demand pull inflation. This happens when demand for goods and services is greater than production capacity, therefore prices go up. Next, you have the cost push inflation. This is when production costs go up, therefore cost of final products also go up. Lastly, you have the built-in inflation. This is when expectations of inflation causes inflation. Inflation, as typically discussed, is measured by CPI, or the Consumer Price Index. Now, the CPI measures the overall change in price of a weighted basket of goods and services that are representative of consumer spending. These goods and services are from 8 major groups, including housing, apparel, transportation, education and communication, other goods and services, recreation, medical care, and lastly, food and beverages. But CPI is not the perfect measurement for inflation. In fact, there is general consensus that CPI underestimates the true impact of inflation. Some argue it doesn't even measure inflation, rather a range of consumer spending behaviors. You must realize that the government has incentives to try to keep this number as low as possible. The CPI is perhaps one of the most important government statistics because it impacts a number of public programs and is used as a benchmark for setting public policy. Now, the accuracy is questionable, especially when you compare it with other agencies' inflation measures. So why does the government want the CPI number to be low? The CPI is tied to over 80 million Americans, specifically Social Security beneficiaries, food stamp recipients, military and federal civil service retirees and survivors, and children on school lunch programs. So to put it simply, these are all the folks that rely on a government check every single month. Therefore, the higher the CPI, the more money the government has to dish out on these income payments in order to accommodate the cost of living. However, this same government is over $28 trillion in debt. And here's the scary part. The government has never been in this much debt with the CPI being so high. This is truly unprecedented.
Oh, okay, goddamn.
But enough about the CPI. There's another measurement that will tell you more accurately the inflation numbers, and that is the PPI, which is the Producer Price Index. Investopedia says the Producer Price Index measures the average change over time in the prices domestic producers receive for their output. In other words, the PPI measures inflation from the perspective of the producer and not the consumer. As you can see, PPI inflation has skyrocketed over the last year. Over the last decade, it's mostly hovered at 0 to 4%, but currently it's sitting at around 11%. This means that the costs for producers are increasing, which in turn, they're forced to pass on this high cost to consumers by raising the prices of their goods and services. So how do we get to such a high inflation environment? Well, there are endless debates on this topic, but it most likely has a lot to do with the unprecedented money printing in the past couple of years, running in the trillions. plus supply shortages from the pandemic and war in Ukraine. High inflation is especially bad for growth stocks and crypto. And why is that, you might ask? Growth stocks have high multiples, meaning a lot of their valuation is justified by expected future earnings. If inflation is high, then the real value of those future earnings is lower. When inflation increases, growth stock prices plummet. The crypto markets have also been highly correlated with stocks for the past couple of years. Or more likely, they're both correlated with liquidity. Remember how the central bank printed trillions in the past couple of years and flooded the market with liquidity? This is called quantitative easing, or QE, and this pumps the asset prices to the moon. But the Fed can also do the opposite, which is called quantitative tightening, or QT, where they can literally delete this money and withdraw the liquidity from the market. Increased QT means crashing crypto and equity prices. Of course, the Terra Luna fiasco only exacerbated the crypto market crash, initiating the contagion effect on the multiple implosions of top CeFi companies and wiping out hundreds of billions in the crypto market. I know this all sounds scary and that we're all doomed, but I'm still optimistic about Web3 and crypto. Builders will keep building, global adoption continues to accelerate, and even in times like these, inflationary times, Bitcoin is still dominating the crypto market. Lastly, I wanted to say thank you for Shivsack on Twitter. This guy's got amazing threads. A lot of today's video, a lot of today's content came from his threads. Guys, that's it for me. Thank you for watching. Keep compounding, and I'll catch you on the next journey.